I own a Dividend stock that I really like. It's a smaller position in my portfolio, but I really like it. I think this company has a ton of promise, but I have not heard anyone out there on YouTube cover this stock yet. I haven't heard a lot of discussion or really any discussion about this company in the comments section below. And so I thought it would be fun today to share another position in my personal stock portfolio. And if you have not guessed by now from the Play-Doh, from Spider-Man and Captain America, and also this Mr. Potato Head and Hulk, I am talking about Hasbro. So I want to take some time today. I want to discuss my personal experience with Hasbro, being a shareholder in Hasbro, and walk through this company a bit in today's video stock analysis. So let's get started. This is such a fun company. My son, he loves playing with these Hasbro toys, and I know as my daughter gets older, she's going to enjoy these Hasbro toys as well. They have so many amazing brands. Maybe I'll start with that. This is a toy company, an entertainment company geared towards children, but adults like it as well, quite frankly, because they have movies now. For example, they own the Transformers franchise, and with that, they're not only producing Transformers as toys, but these movies as well, and they're receiving licensing fees for these movies. And so this is such a cool company. And they have brands like Nerf, My Little Pony, Monopoly, Play-Doh, Transformers, Magic the Gathering. They have games like Jenga as well, and Playskool, and the list goes on. They have so many different toy brands. And I personally started purchasing Hasbro stock back in 2014. I started buying it at in the low 50s, actually. I averaged in quite a bit. One of the first big purchases that I made was for $53.73. Now this stock right now is at $88.41, and so I am up 64.5% on that first big tranche that I purchased back in 2014. But this really is a smaller position in my portfolio. When I look at this position, I look at it as compared to my portfolio by dollar value. It comprises 1% of my portfolio, so smaller position. I actually like it quite a bit. I'm thinking about adding more here if the share price drops more. And so I'd be curious, before I even go on, put in the comments below, do you own Hasbro? Have you thought about it? It's really interesting that I've just not heard anyone here discuss Hasbro before, and so that's why I'm so excited about this video. Anyways, they pay a dividend of 63 cents per quarter, or $2.52 per year. The current yield, it's 2.85%. I just take that 252, I divide by the current share price of $88.41. That's how I get to the current yield of 2.85%. But my yield on cost for me is quite a bit higher because I've been owning since 2014. So if I take the current dividend yield of 252, I divide by my purchase price, which was $53.73. My yield on cost after owning this thing for just 4 years is a 4.7% and growing. And so that is the power of dividend growth investing. I invest for dividends for cash flow. I want to use the dividends to pay bills. And the magic, the secret sauce is this concept here of yield on cost, that I can buy a stock, hold it, and enjoy the dividend increases over time that give me progressively more cash flow. And my yield on cost here is a simple yield on cost. I'm actually reinvesting all of my dividends, so it compounds my yield on cost even more, not even taking that into account here in this model. This is just a simple yield on cost, taking literally the dividend now divided by purchase price, assuming I spent my dividends all along the way, but I didn't. I've been reinvesting them, so the actual results are even better than my yield on cost implies. So really exciting, done really well with this stock, but the stock is facing some challenges right now. We'll get more into this later, but with the advent of Toys R Us going out of business, this has really placed a lot of pressure on Hasbro this year in 2018. So we'll talk about that later. But because of that, the stock has fallen. It's actually down about 19% from its 52-week highs, so not that much, but 19%, you know, it's down from the high, yet I'm still up 64.5%, which is awesome. Now, I don't invest for capital appreciation, I invest for dividends, but I always like pointing it out when I receive some capital appreciation, because it just goes to show that a lot of investors out there, they think dividend investing is boring. They think capital appreciation is not possible. They think it's just for dividends, not for capital appreciation. But nothing could be further from the truth. Dividend investing, in my opinion, it is not just for dividends, it is for capital appreciation. Now, the capital appreciation doesn't really do that much for me. It surely helps my ego, but since I never plan to sell, I just hold forever. I use the dividends eventually to pay bills. I'm not doing it now, but I will eventually to pay bills. I don't really need the capital appreciation, but it sure is nice to see, and it's reflective of a well-managed company, of a company that has done well. So, moving on, the dividend in 2014, when I first started purchasing, was 43 cents per quarter. Now it is 63. The compound annual growth rate has been 10% over that 4-year elapsed period. And so on average, over the last 4 years, they have grown the dividend per year by 10% on average. Now, this may taper off a little bit here for the next year or two, if I had to guess, because they are facing some short-term challenges with the whole Toys R Us thing. We'll get to that later. But I surely think that the rate of growth of their dividend, it will continue to increase over time. It will be strong because this is a growth company, and we'll get into that in a minute. That's one of the reasons I love this company. So moving on, payout ratio. The payout ratio is 58%. So if I just take, and this is a 2018 forward payout ratio, by the way, if I take the dividend per share and I divide by the earnings per share, I get a payout ratio of 58%. On a forward basis, the PE for 2018, look, 2018 here is almost over. When the analysts are expecting, based on the analysts' expectations, I get a forward PE of 20.51. And so it's still trading, quite frankly, at a pretty rich valuation. And I think it's characteristic of this company to have a rich valuation because historically it has been a really fast growing company. As I have seen just in the time that I have owned this, it's grown quite well. $11 billion market cap. I love that. It's a smaller market cap in my portfolio. I view it as more of a growth company. I think there's a lot of upside with this company, and so I like that. By the way, I would call this a consumer discretionary. A lot of the stocks I cover here on my YouTube channel are consumer staples. They're stocks that produce companies that produce products that people need no matter what. Products like food, for example. However, this is more of a consumer discretionary. When times are really good, families can afford toys for their children, lots of new toys. When times are not so good, look, the kids still need new toys, but families have a choice and they may choose to slow their spending. And so that's one thing just to be aware of with a company like this is not a staple. You don't have to go out and buy these types of toys for your children when times are really bad, but you surely have to provide food, you have to have a roof over your head, you have to purchase the necessities. And so something to keep in mind. That said, this stock really has performed kind of like a consumer staple because I think most families, they oftentimes will do what it takes from a parental standpoint to make sure that their kids are provided for, and everyone wants their kids to have the best. And quite frankly, one of the reasons I love this company so much too is in the age of screen time, in the age of electronics, it sure is nice to also have the option for families, for parents to provide toys for their children that are a little bit more old school, that really challenge kids in different ways than a computer screen would, for example. Although this company has all different types of experiences, both screen-based and traditional as well. So moving on, their Q3 earnings report came out recently, and it was not very great. It gives an indication of what is happening to this company because of Toys R Us in 2018. And quite frankly, there was also recently a class action lawsuit announced, and shareholders are complaining that basically this company misled them, that they led them to believe that the results would be better than they are. And this gets me thinking, boy, there's always class action lawsuits with any company I own. I see these all the time. But what kind of gets me here a little bit, piques my interest a little bit, gets my radar up, is $11 billion market cap. This thing is potentially ripe for an activist investor to come in and say, hey, you mismanage things, let me see what I can do. I hope that is not the case. I tend to dislike activist investors. I've discussed these on my channel before. We will see, but personally, a lot of these class action lawsuits, I just think they're oftentimes silly. And in this case, look, Toys R Us, this was a really big fundamental shift in this industry, and I actually think they're doing quite well in face of it. But let's look at that. Revenue was down 12% in Q3 year over year, because mainly of Toys R Us. And earnings per share, though, was essentially flat. It came in at $2.06 for the quarter versus $2.09 the year before. So thank goodness the earnings per share was bolstered largely by tax reform. So tax reform really came at the right time for these guys in this challenging transformational year with the lack of that channel, that big channel of Toys R Us. But going ahead, actually, I was watching an interview with the CEO of Hasbro, and what he was saying is in 2019 they expect to return to growth, and one of the reasons for that is they have pivoted. You know, they used to rely on Toys R Us for quite a bit of their revenue, quite a bit of their sales, and they are pivoting and they are finding new distribution channels. They are engaging new stores, different stores, increasing their network more than they ever have before. And so there's a lot of promise for this company to renew their growth in 2019. So I thought that was really cool. And maybe that's one of the reasons that the stock is doing all right, because people kind of see greener pastures right around the corner here. So moving on, revenue. I'm looking at the Q3 report again. US and Canada was $924.2 million, international $560.7 million, entertainment and licensing $84.8 million. What I like about this company, and you guys know this if you've been following my channel for a while, is they have a really good international component to it, and I really value companies. I value companies quite a bit in my dividend portfolio that have exposure to international. And so this company, 59% US and Canada, 36% international, 5% entertainment and licensing. And so I just thought that was nice to see a good international exposure. I actually didn't expect that of this company. I didn't expect to see international so big, and I like that. By the way, from a revenue standpoint, US and Canada was down 7% year over year, 24% year over year decline for international, got hit real hard because of Toys R Us. And entertainment and licensing was up 45% year over year, so that's been the growth driver. Again, not a very exciting quarter, not a very exciting year for Hasbro, but I think they are maneuvering well. They have a strong balance sheet. I'm not going to actually discuss that in today's video because I ran out of space on my whiteboard here, but I think they're managing their debt very well. I think they're managing their cash very well, and I think they've got what it takes to pivot and, as their CEO is saying, resume their growth again in 2019. So let's get into that actually. You guys probably can't see this as much, but what I did next is I looked at their 2017 annual report, and I just looked really quickly here. But what I wanted to look at was revenue, earnings, and earnings per share. Revenue comparing 2017 versus 2013 is up 28%. So comparing that period of time from 2017 versus 13, 28% growth in revenue, that is pretty darn good. I like that. Gets even more exciting. Net earnings are up 40% when I compare 2017 versus 2013. earnings per share are up 44%. So before this whole Toys R Us thing came about, this company was on a really fast ascendancy, really fast growth rate. As I had pointed out before, the dividend is growing really quickly, 10% per year on average. And so this is the kind of company that I really like having in my portfolio. The starting yield, it is not that exciting, but looking 10, 15 years out, my yield on cost is going to be phenomenal. They got thrown a curveball with this Toys R Us thing, but we'll see. I think they're going to pull through it just fine. Now, on the downside, though, I'd say the cons, obviously they have to deal with Toys R Us. Now they've got this class action lawsuit. They got to deal with that. Also, they do have lower net margins and operating margins at this company. I didn't calculate the margin here, but just looking at 2017, for example, revenue was $5.2 billion. Net earnings were $397 million. So this is historically a lower net margin business, and when one has lower margins, it leaves less margin for error. And so typically I like companies that have higher margins, and so if there's one thing I would say about this company that I potentially dislike is, look, the disruption, the Toys R Us stuff, any company is going to be faced curveballs over time, disruption, challenges, and so I rely on great management teams to make it through that. But what fundamentally will not change with this company unless they really pivot their business is the margins. And so it's just something I have to become comfortable with. There's a lot of things I look at when I analyze a stock. Not all of them are always going to be on target. And with this company, one thing that is a little lower than I typically like to have in my portfolio is the net margins. It's a little bit of a lower margin company, but I think it comes with the territory. It comes with the space that they are in. I would love to hear from you guys. What do you think about this company? And I imagine if you have kids, you are probably quite familiar with these toys, these Hasbro toys. They have so many amazing toys, amazing brand. Kids love them. I would be curious what you guys think. Please put it in the comments below. I'd be curious, why has no one brought this thing up here on PPCE? And I'd be curious if anyone has just a philosophy, a thought, a hypothesis as to why that is. And so I can't wait for the comments on this one, because it really is just this fun stock that nobody really talks about it, but I really like it. It's only 1% of the portfolio, but I could see it going up to 1.5%. I could see myself adding more. I don't want to add more yet at a PE of a forward PE, that is 2018 of 20. But if the PE on this thing trended down maybe to the 15 range, maybe 17, 15, somewhere in there, I would like to pick up a few more shares because I like the growth. This is a nice growth story, dividend growth story. Hey, thank you everyone for being part of the video today, for being part of the PPCE and community. If you want to support my channel, the best way you can do that is to give a like, subscription, comment, all of that. It truly, truly means the world to me. Thank you to all the support out there. We are 17,000 dividend investors strong. Hey, before I leave today, in terms of a full disclosure, I am long. I own shares of Hasbro, ticker symbol HAS, in my personal stock portfolio. Also, I am long. I own shares of Cedar Fair, ticker symbol FUN. I thought I'd point that out because I mentioned FUN up here. And I own shares of 3M, ticker symbol MMM, makers of this amazing Post-it whiteboard. Also, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult a licensed financial advisor first. Literally, just here on YouTube, sharing my personal journey for fun and entertainment. Hey everyone, I will see you in the next dividend investing video.